but the core inflation will remain below 4%. Inflation revised downwards. Headline inflation to be softer on the back of the high growth numbers, right? Softer hit.
Yeah, I mean, there was a tough dilemma whether to do it or not, because most of the experts were suggesting maybe the RBI might not. But it seems that the RBI is confident that the inflation is controlled, and that's why maybe they're doing it. Because what repo rate is essentially the rate at which the RBI, makes that short-term lending to banks. Now, what it does is, if the repo rate is lower, it can lead to an increase in money supply. Sanjay Malhotra, the RBI governor, is speaking. Let's cut to that.
Outlook. Q3 is at 0.6% and Q4 moves up to 2.9%. CPI inflation for Q1 and Q2 next year are projected at 3.9 and 4% respectively. I may, however, add that the underlying inflation pressures are even lower, as the impact of increase in price of precious metals is about 50 basis points. The risks are evenly balanced. I will now draw your attention to the external sector. India's current account deficit moderated from 2.2% of GDP in Q2 last year to 1.3%. This is a decrease of about 0.9% in Q2 this year, on account of robust services exports, which continue to do well, and strong remittances. In October 2025, merchandise exports contracted YOY, whereas merchandise imports continued to increase for the second consecutive month. This resulted in widening of the trade deficit. Healthy services exports coupled with strong remittance receipts are, however, expected to keep our current account deficit for this year modest. On the external financing side, gross FDI to India increased at a robust pace during the first half of the year. Net FDI too increased significantly due to a decline in repatriation despite a rise in outward FDI. FPI to India recorded net outflows of $0.7 billion this year so far, basis figures till December 3, primarily due to outflows in the equity segment. Flows under ECB and non-resident deposit accounts moderated as compared to last year. As on November, the MPC met on the 3rd, 4th and 5th of December to deliberate and decide on the policy repo rate. After a detailed assessment of the evolving macroeconomic conditions and the outlook, the MPC voted unanimously to reduce the policy repo rate by 25 basis points to 5.25% with immediate effect. I repeat, the MPC voted unanimously to reduce the policy repo rate by 25 basis points, and the RBI.
Okay, let's understand. Our business editor Pranav Kulkarni joins us live for more on this. Pranav, this is the third or fourth round in which the RBI has cut the repo rate about 100 basis points earlier, and now a 25 basis points, so to say. Increases money supply, which shows that the RBI is very confident that inflation is in control.
Well, absolutely. In fact, if you look at it, if you look at Sanjay Malhotra's address, he specifically mentioned that inflation is well under control, and going forward as well, it is expected to remain well within the RBI's speculated limits. So there is enough space for cutting the repo rate and inducing more liquidity, is what the RBI governor said. He also mentioned some of the other important things, which is in fact what provides the basis for a further space for a repo rate cut, which is that manufacturing has been doing fantastically well. He said the impact of GST, in fact, on inducing consumption has been something very positive that has worked well for the economy. The balance sheets of India, that is corporate results that just came out, have been encouraging, and that is these are in fact some of the reasons behind the RBI taking a decision to reduce the repo rate by 25 basis points further.
Thank you for joining us with those inputs from the Republic Business Desk. A big update this morning. Let's move on now and get you the big coverage of Vladimir Putin's visit to India. In a few minutes from now, in exactly 45 minutes, his engagements will begin with the ceremonial welcome